Hi, everyone. It's great to be here today. By way of introduction, I'm Adam Hornung, Co-Chief Operating Officer here at Hillhouse. And as we think about the backdrop of today's investing environment, high interest rates, high inflation, private equity is obviously having to evolve. As we look back at the development of private equity investing over time, the drivers of value have included high yield, low inflation environment that have, I think, a lot of folks have grown accustomed to. Feels like we're at a turning point now, maybe a new regime in the markets. And with that, we have Theresa Whitmarsh, the former Chief Executive Officer of the Washington State Investment Board, is joining us to consider how institutional investors are assessing the next phase of value creation in the private equity space. So, Theresa, let's turn it back to what we're going to call private equity 1.0. It's 1981. Hopefully, you remember those days. And Washington State Pension Fund is making its first commitment to private equity. This is at a time when, of course, leverage was starting to come on board. Financial engineering was starting to be used in these types of transactions, and turnaround expertise were some of the bigger drivers of the returns in that new asset class. So, Theresa, maybe you could start by speaking to the dynamics of the wider market at that time and the discussions that framed the early commitment that the Washington State made into private equity.
Sure. Thank you, Adam. I really enjoyed preparing for this conversation because it gave me a chance to reflect on literally 40 years of being associated with this asset class. But, you know, you talk about the wider market. Really, there was no wider market in 1981. Venture was really a cottage industry. It was small. Funds were small, primarily raised from private wealth firms and private individuals. And the investments were in companies that were too small to raise capital in the public markets. And at the same time, in parallel, buyouts were primarily the domain of merchant banks, and they were using their balance sheets to buy troubled companies and turn them around. There was no institutional capital flowing into buyouts. So how did we end up getting into both venture and buyouts in 1981 and 1982? I always like to say asset allocation is often an accident of history. And we had two things happen simultaneously. Our first executive director, who was hired around that time, came from California and had relationships in the Silicon Valley. And he was a fan of venture and really pushed to get that asset class. It wasn't an asset class at the time, but to get that strategy as an option for institutional investors, particularly for the Washington State Investment Board. And at the same time, on the buyout side, our neighbor to the south, the Oregon Investment Council, had begun conversations with KKR, who was interested in getting institutional capital into the buyout market. So we ended up making our first venture investment in October of 1981 and our first buyout fund investment in early 1982.
Through this bull market, we really kind of came into maybe private equity 2.0, where there was, of course, a lead in using leverage was still a big aspect of it. Rates were low, inflation was low, and so the economic drivers were good. There was obviously move to optimize and financial engineer that had always been in private equity. But there started to become a highly competitive environment, right? A lot more asset managers were coming on board. A lot more asset allocators were discovering the space as we've identified, and it became a much more competitive space. I think one of the differentiators at that time started to become optimization, value creation, development of portfolio. Maybe you can walk us through, as you were looking at and evaluating private equity firms, how that became a big aspect of the consideration kind of through this bull market, and what some of the differentiators are in that space.
Sure. So I think the tools available to a private equity firm are more extensive than, say, to a stock picker. If you buy a really good business or even buy a bad business and turn it around, there's just a lot of tools available to a PE firm to make that successful, no matter what the current market environment is. So whether that's governance or changing out management or optimizing distribution channels or expanding into new markets, there's all kinds of things in the toolkit of a private equity firm to turn a company around. And when I think about traditional buyout, the type of investments that Hillhouse does, such as air conditioners, women's shoes, batteries for electric vehicles, these are proven businesses in established industries optimizing for today's evolving economy. I think those types of opportunities, good businesses are always going to need capital, and there's always going to be good businesses in any market environment, but not every asset manager has the tools to turn those companies around. And I think private equity has worked very hard to develop that tool set.
We've had this conversation about investing into and through and on the back end of crisis and over the long term having consistent returns. If you're able to do that, that takes a lot of patience and of course a lot of courage to accomplish that. Why do you think this is so important? And what did you do on the asset allocator side to build that confidence in your organization? I think this is particularly appropriate in today's time, where we're coming into another choppy and volatile economic environment. So what were some of the things that you had to do to convince and build confidence in your board and to kind of weather those storms?
We had established investment beliefs that said we believed in illiquidity risk premium, we believed in an equity risk premium, we believed in reversion to the mean. And so we reviewed our investment beliefs. We did a whole facilitated session with the board. Do you still believe all this? Yep, still believe all this. The second thing we did is we reviewed our capital market assumptions, which is, the expectation of what each asset class we think is going to deliver over time and the volatility around that. Do we still think the same way about our capital market assumptions as we did pre-crisis? And we agreed we did. And then we reviewed our risk tolerance statements. What kind of risks, what are our liquidity needs? How much could we lose and still feel comfortable? Some of our peer funds, were forced to de-risk. They had boards that panicked, they had stakeholders that panicked, they had legislators that felt these asset classes were too risky. So I spent a lot of my time educating not only the board, but our key stakeholders that if we stay the course, we're going to do fine. And we did.
Did you find that through cycle investing built confidence on itself? So you've described so far 1.0 and 2.0 of some bad times, but some good times, but some bad times and some good times. But as you said, consistent returns throughout. Do you think that built over time the confidence in this asset class that you think has some stickiness to it still today?
Yeah, I think so. And I think that's why there's so many flows coming into private equity right now, is it has been, it did prove itself through the recession. I mean, I think, obviously there's some new concerns today. The cost of capital is higher than it has been for 2 decades, though I don't think it's high enough to be alarming. But I think, one of the things we chatted about earlier, and I kind of wanted to make this point, is the highest performing vintages are years when, post-recession or, like the tech bubble and the great financial crisis. But unfortunately, not a lot of capital gets called in those vintage years. and those turn out to be the best performing. And I think funds that have dry powder and the courage to invest countercyclically are ones that we really admire and respect. But unfortunately, it doesn't happen a lot enough. And I think a lot of it is managing the human behavior of market cycles.
Just to kind of get back to where we started this conversation, the world is changing all around us. A lot of uncertainty, rates are high, global markets are choppy. There's probably what I would define as a lack of confidence out there and a lack of stability. So it's a different world. I'm curious to understand, how do you think asset allocators view the outlook ahead and in the private market space? And will there be a change to that asset, that view of private equity, or will they change the asset allocation within the broader portfolio? Will it be more of a reversion to yield investments, given the kind of returns that you can generate?
I think it's $1 trillion question. I was at a conference this past week with a number of CEOs and CIOs of institutional investors. And top of mind was private equity. It got a lot of discussion, and whether there's still high conviction in the asset class. And I think, what I heard from some CEOs is concern that they're not getting paid for the risk being taken, particularly in emerging markets. And they're questioning, are the returns going to be there? And is there enough growth in those markets to take the risk compared to developed markets? I think risk is viewed wrong. I think the measure, if risk is volatility, then yeah, maybe there's concern, but I don't, for long horizon investors, which pension funds are, it's long-term patient capital, or it should be. It strikes me that one of the things allocators should consider about private equity in Asia is diversification. It's not talked about enough. I think Asia provides diversification beyond mere geography. It's a diversification of returns, expectations, of volatility and exposure. And so I think, simply put, private equity is a different point in its maturity in Asia. It actually reminds me a lot of of the evolution of the U.S. Institutional PE market. It feels to me that Asia is still in early days, but with very mature managers and very mature companies that I think there's nothing but room for up over time. I'd love to hear your thoughts on it. You're the pro on Asia, not me.
Yeah. Well, obviously it's an evolving market. It's maturing. It's not at the same stage as other geographies in certain ways, but it is in many other ways. The markets are sophisticated and operate efficiently. There is really high quality businesses. Like you said, there are high quality asset managers. There are unique businesses that are providing global outcomes and in fact providing really advanced research and development or advanced supply chain management. So there's a lot to be interested in and a lot to find investable in the space. But at the same time, the markets, some of the debt markets aren't used in the same way as they are in maybe in other jurisdictions, which I believe reduces the risk of the portfolio in this region. It's a place that has still the volatility that you would recognize in an emerging market. But the good news is that because there's less leverage used in these companies, there is generally less complete downside or risk of complete loss in the space, which makes it, I think, an interesting space for asset allocators. On top of that, it still has a lot more growth potential, obviously, as it continues to emerge. If you think about Asia, you've got some pretty developed economies, the second largest economy in the world, and you've got Japan and you've got Korea, but you also and Australia, but you also have emerging economies like Indonesia and India that present really great growth opportunities. It's a unique mix in Asia to be able to have all of that in one area, and I think a lot of it works off of each other as well. You get research and development, perhaps from China, that can generate opportunities in Australia, and Australia iron ore that can generate opportunities in India, and India business services that can generate opportunities for Japan or Korea or the United States. So there's a lot of interconnectedness in it that I think creates a lot of opportunity as well. More broadly, there is a real interconnectedness that exists throughout the world, and that's really starting to develop. What we've seen is obviously a lot of focus on supply chain over the last few years. We have spent a tremendous amount of time trying to help companies with supply chain optimization. And you'll see today there's a lot more regionalization of supply chain for a variety of reasons. That makes supply chain complicated, right? And I think there's a lot of businesses out there that, when referring back to the kind of the deep value creation mindset that we talked about earlier, there's a lot of companies out there that really benefit from supply chain optimization, some work on digitalization of supply chain, obviously direct to consumer kind of supply chain through to consumer supply chain, and then of course in today's world, not only the supply chain side of it, but also the distribution side of it, and whether it's omni-channel distribution or online, distribution. But there has been a shift into this private equity 3.0 in our minds of needing to be a value creator, but also needing to be a partner with some of these businesses to help them digitalize. And that's been a big focus for us, for these traditional private equity businesses, is to help them optimize supply chain, regionalize supply chain, think about distribution, think about research and development on a global basis. And so because of that interconnectedness and because of that cross-geographical exposure to a variety of different companies and supply chain, I think there's a lot of opportunity for a lot of traditional businesses today.